Since September, mortgage rates have been on quite the roller coaster. They dipped into the low 6% range, only to climb past 7% by the end of October, and now they're back into the 6s again. If you're feeling overwhelmed, you are not alone. These unpredictable fluctuations can make home buying feel like a guessing game. But the good news is you don't have to wait for the perfect rate to achieve your home ownership goals. The reality is there are opportunities for buyers no matter where rates end up. By understanding the factors behind mortgage rate changes, you can feel more comfortable, more confident, and better prepared to lock in the best rate for your situation. Let's break down what's driving these ups and downs and how you can move forward with confidence. What is behind mortgage rate fluctuations? While mortgage rates may seem random, they're actually influenced by a range of economic factors, including inflation, Federal Reserve policies, and the broader state of the economy. Here is a quick overview of the main drivers of interest rates. 1. Federal Reserve influence. While the Fed doesn't set mortgage rates directly, its decisions on the federal funds rate have a big impact. When inflation rises, the Fed often raises interest rates to curb spending, which can push mortgage rates higher. 2. Financial markets. Mortgage rates are closely tied to the performance of Treasury bonds and mortgage-backed securities, with a spread that reflects the risk investors take on when purchasing mortgage-backed securities. 3. Government policies. Government programs such as down payment assistance or tax credits can increase demand for homes and lead to higher mortgage rates as more buyers enter the market. Economic growth and employment rates. A strong economy and low unemployment typically pushes rates higher due to increased demand for loans. In contrast, when the economy slows, mortgage rates often fall to encourage borrowing. Next, global and political events. World events such as wars, pandemics, or major political shifts can affect U.S. stock and bond markets and in turn affect the mortgage rates. So how do we plan for monthly mortgage costs? With rates fluctuating, planning your monthly mortgage costs may feel daunting, but there are ways to budget effectively, even in a high rate environment. Try using an online mortgage calculator. Start by estimating your monthly payment based on different rates and down payment amounts. This will help you visualize different scenarios and determine a comfortable monthly payment. Factor in additional expenses. Your mortgage payment includes more than just the principal and interest. It can also cover property taxes, homeowners insurance, and private mortgage insurance. Private mortgage insurance is included if your down payment is less than 20%. You also want to account for rate fluctuations. If possible, budget for a slightly higher rate to give yourself a cushion. This way, if rates rise before you close, you won't be caught off guard financially. By planning carefully, you can stay confident in your budget and be ready for any rate changes that may come. Tips for securing the lowest possible mortgage rate. Homebuyers today are getting creative to secure better rates. In fact, 45% of people who bought homes last year managed to lock in rates below 5%, according to Zillow. How is this? Many buyers are leveraging builder incentives, seller financing, refinancing, or even help from family and friends. Here are some strategies to help you score a lower rate. 1. Boost your credit score. It's a well-known fact that the higher your credit score, the lower your interest rate. Here is how to improve your credit. You can pay down existing debts. You can avoid opening new credit accounts before closing on your new home. You can consider using rent reporting services, which can boost your credit score if you've been paying rent on time. A higher credit score signals to lenders that you're a reliable borrower, which can save you thousands in the long run. You can also consider mortgage points or a rate buydown. Mortgage points or rate buydowns involve paying upfront fees to reduce your interest rate. Nearly 23% of buyers who secured rates under 5% last year used this strategy. Some builders may cover the cost of points to attract buyers, but it's a strategy that works for resale homes too. Just be sure to assess the break-even point to ensure long-term savings outweigh the upfront costs of doing this. Talk to your loan officer to see if this fits with your financial goals. Explore alternative loan types. Most buyers opt for a 30-year fixed-rate mortgage, but adjustable rate mortgages and shorter term loans can offer lower initial rates. With an adjustable rate mortgage, for example, you start with a lower rate that can adjust after a few years. This can be a smart option if you don't plan to stay in the home for decades. Just be cautious as your payment may increase once the rates adjust. You can also look into down payment assistance programs. A larger down payment can help you secure a lower rate, but if saving up a large sum feels impossible, consider down payment assistance programs. Zillow reports that 60% of first-time buyers used assistance, which can help make home ownership more affordable for you. You can negotiate with sellers or builders. As inventory increases, sellers and builders are offering more incentives to close their deals. According to recent data, 35% of buyers in 2024 secured lower rates through seller incentives. Don't hesitate to negotiate on closing costs. They could lower your monthly payments significantly. Now, mortgage rates may rise and fall, but your path to home ownership doesn't have to be uncertain. Start exploring your options now and consult with your mortgage lender to make informed decisions. Remember, it's not about waiting for the perfect rate because that may never come. It's about making the right choice for your unique situation. With the right strategies, you can find an opportunity that works for you no matter where rates land. If you have more questions, reach out. If you want to learn more, watch the next video.